All right, we are going to look at the lump sum study, but we're going to examine the internal rates of return on two of the best options, both the 3-pay and the 4-pay scenario that we looked at in the last video, then also the guaranteed values, which is always beneficial to at least look at in my opinion, and we're going to examine the internal rates of return on the guaranteed values as well. So let's get on into it and have some fun, shall we? Shall we? All right, so let's start off with exactly where we left off regarding the best options. We looked at anywhere between a 1 to 5-pay scenario, that $1 million lump sum, getting it into a policy and not paying a penny thereafter, all non-MEC scenarios. So here's our 3-pay, and then here's our 4-pay. And the cash value difference, you see that the 4-pay had slightly more. As we look at time, what do we notice here? Not a huge difference. Let's look at age 85. The difference in cash value is what? Just under $8,000. So before we jump to the internal rates of return, let's look at the guaranteed values. So this assumes a guaranteed interest rate, no dividends, as I was going to say dividend interest rate, a guaranteed interest rate of 3%. If you saw the first video, we talked about the difference between a dividend rate and the net internal rate of return. Granted, the guaranteed rate here is 3%. That is never what I will actually earn when I look at the internal rates of return. And you can kind of see that just with respect to how long it takes to get my $1 million back. So there's my 3-pay, pay $1 million in, takes 10 years. How about over here? Pay $1 million in, I get it just about year 9, I'm positive there. So it takes much longer based on the guaranteed rate. So let's take a look at the different values here. And I want to scroll down to age 85. What was your difference on the non-guaranteed values? In fact, let's go back to the 3 versus 4-pay. Difference by age 85 was what? Just about $8,000. Going to the guaranteed rate or guaranteed values, I see 1.662 compared to 1.695. So let's do the same thing and put the cash value difference column in here. There we go. So initially, we see the first 3 years, the guaranteed values are stronger with the 3-pay. This is how much less money I have in cash value with the 4-pay. Why I have less in the first 3 years is because I still have to pay another $250,000 in. I got the $1 million in faster over here. Then, there's my premium. Same thing over here. This is good to look at with lump sum scenarios. If you intend on looking at a premium offset to know if your value will always go up, when I look at the guaranteed rate only, no dividends, do things continue to climb up? Does my cash value continue to appreciate? Only looking at the guarantees. In this particular case, yes. So with no dividends, just the 3% gross guaranteed rate can support the base premium, and I have enough left over where my cash value continues to appreciate. How about over here with the 4-pay? Same thing is true. Very good. And then once I go reduced paid up, gets much better. But what's the cash value difference here by age 85? It's not $8,000, it's about $33,000. And again, depending on my age, funding amount, gender, these values can vary here. But you will see a difference when looking at the guaranteed values compared to the dividend values. So let's take a look at some internal rates of return, shall we? So let's first look at, why don't we start with the guarantees actually? Then we'll go back to where we left off with, or what we left off with. So guaranteed values here. Make that a little bit better. Beautiful. Annual IRR and average IRR. Annual internal rate of return, I often like to refer to that as that's what I'm earning year over year. A nice question to illustrate is, what did you earn last year in the S&P 500? Market hit a home run, I did 30%, great. What did you average out over the past 30 years? Well, I earned an average of 7 or 8%. Same thing here, annual IRR isolates what I'm earning year over year. Average IRR takes into account all of the years. So I can look at my 10-year average, 20-year average, so on and so on. So as I look at the internal rates of return, keep in mind that the guaranteed rate on this product is 3%. Does it ever hit 3%? The 4-pay is a bit stronger, so let's focus on that. The annual IRR will be the strongest, and you will notice a jump once we execute a reduced paid up option. There the IRR takes a nice jump, about 100 basis points. Quite nice. Same thing over here, it's actually a little bit more. But what do you notice regarding the annual internal rates of return beginning year 8? I'll get those columns captured. Beginning year 8, annual IRR, 2.49. 2.49. If we were to look at the 1-pay, 2-pay, 3-pay, 4-pay, and 5-pay, they're all the same. And it does depend on the company and product I select. This is Guardian. Same product, apples to apples. When we execute a reduced paid up option, a nice way to illustrate it is the playing field is leveled. Whatever cash value I have based on my age, that's going to purchase me a certain amount of death benefit. Based on a guaranteed rate, no dividends accumulating, the death benefit will not increase if I'm only looking at the guarantees. But when I go reduced paid up, there's no premium due. I'll see that my annual internal rate of return, it's only based on what I have in cash value. That's exactly what this formula is based on, and the growth rate. What is it growing by year over year? And it is identical. The average IRR is not, because that's based on my overall cash value growth, factoring in the early years and such. And because I've got more money in the 4-pay, you will see the average internal rate of return is higher with the 4-pay example. So let's go down to where we have been going. Age 85, 1.54 on the average internal rate of return, compared to over here, 1.46. So that's what you averaged out. Safe, liquid, tax-free area to position money. This is absolute worst case scenario. We've always seen the products do better than this, but it is good to look at this. So absolute worst case scenario based on your age, health rating, right? There are factors that could impact this and make it look better or worse. Term rider expenses are one of them. Let's look at the IRR based on the present dividend rate. Here we go. So this is based on the 2022 dividend interest rate, 5.65%, 3-pay versus 4-pay. Not everyone wants to look at all of this. Some people do, because the first objective is maximizing the policy value, cash value, death benefit. Then the next objective is putting the money in use. We're going to look at that in the next video, leveraging the policy and such, and really what to look at here too. There's the annual and average. What do you notice as time passes? Same thing. In year 8, the annual IRRs level out. Oopsie daisy. There we go. 4.67, 4.67. But the average will be a policy that has a higher overall cash value. Age 85 value. There we go. 3.88% compared to over here, 3.94. Right? Minor difference, but the small details, we found a lot of people appreciate this. And then if we don't want to go as in-depth here, we can always scale back and look at the simplified version or the detailed illustrations. But looking at the best options, now we've got the internal rate of return analysis, we've got the guaranteed values. Again, the purpose of this video, really the past 3 videos, is demonstrating what options exist. If I want to maximize the cash value, I've got my one-time lump sum. What was his original question? Remember that? Can I make a one-time payment? Can I move this $1 million into a policy? And I don't want ongoing payments. So show the one-time payment. This way we can see it and how it applies to our individual scenario. And then, oh, by the way, it might make sense to spread the payments out. There are prepaid accounts available if you just want to send a one-time check to the insurance company. A prepaid account, it's kind of like a high-yield money market. We don't have access to it, but it feeds the policy for us for a number of years. You can be creative in that respect. But he did not want to pay anything else in on top of the $1 million. That's where he's at right now. So show him that, and then if he wants to continue to add funds, he can. So there are the different options. What we will look at next is this guy, using the money. Specifically, we're going to focus on cash value collateral loans, and we're going to hit on a point that is raised quite a bit regarding what's the actual growth rate, the internal rate of return on the policy, and then what's the net cost to borrow. This way I can look at them side by side and see if it's costing me more than what I'm earning in the policy. Does the loan interest outweigh the earnings rate in the policy Vice versa, at what point in time am I positive? We're just going to go through it one step at a time. This way it's very, very transparent to us, as the policyholder, that is, when I say us. So I hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.